Welcome to the first podcast for 2014. We've recently published our predictions for 2014 in a separate video, so if you haven't had a chance to see that, do take a look. That is published on our website. We're on the back of a strong 2013 where most of the world's leading markets all managed to post quite healthy gains, certainly in these 10 to 15% region at the low end and in the mid 20% region towards the upper end. And of course Japan was the flyer at being sort of over 50% during the course of the year. China was slightly in negative territory, and in our predictions video we're hoping for slightly better things out of China for this year. It's a call for one for the brave. Anyway, we're going to turn to events for this week and take a look at the diary. At this time of the year, retailers do tend to dominate, the Christmas period obviously being such an important period for many of the retailers, and how they perform over that Christmas period is fairly essential to how the profits will outturn during the course of this year. I think the overall view at the moment is that it's been nothing more than satisfactory, and that has come from the greats of Waitrose, for example, who are saying that. So if you are a weaker player with the wrong stock or the wrong sort of pricing, then of course you are possibly in a bit more trouble. That was the mention over the weekend in the Sunday Times, where Marks and Spencer were moved into a mega sale just before Christmas, extended it from the Saturday into the Sunday in response to disappointing consumer upturn, and the net result of that is that a slight fear that the results later this week are going to reveal fairly poor conditions for Marks and Spencer's, below expectations. The thing we don't know at the moment for Marks is what their profit margins were like, but if they've been saved, it will be in the food division, the clothing side of the business having a poor run of it. Certainly putting pressure on the new CEO, has put the autumn campaign for Marks and Spencer down as pretty important and integral to his management style within the group. It was all based upon that sort of important third and fourth quarter for Marks. So Thursday is going to be of interest for that group. In terms of other things this week, we have had some data out this morning from the Eurozone. In fact, it's Spain, which we'll take a look at some of the charts for Spain that is impressing at the moment. Some employment data coming in over the Christmas and New Year period, which was stronger than expected. And some of the PMI surveys coming through, again, are beating expectations at the moment. It's not the case in France. France is still very much on its knees at the moment. The overall European picture pretty much consistent with expectations. We'll have results this week, as I say, from Marks'. Sainsbury's are also out this week, and the other sort of areas of interest for us. On Wednesday, we have the interest rate minutes from the FOMC. Ben Bernanke gave his last speech last week. Problems with the weather caused quite a few people not be able to attend that particular conference, but he gave a relatively upbeat view of the economy as he exits from his role as chairman of the Fed. Tesco is on Thursday. Again, food retailing, satisfactory from Waitrose. Tesco feeling that the like-for-likes will be in negative territory for Tesco. The negativity around that stock last year, which really caused quite a sharp slump in the share price towards the end of 2013. It's been modified a touch as we go into 2014. The shares bouncing off the 319 low to 332, where they currently stand at the time of this recording. We'll have results from them on Thursday. Big question marks over Tesco and its future strategy. So just turning to some charts, I want to start with a chart of a spread. This is really just taking a look at how the impact of on the European peripheral spreads versus, say, the US 10-year has closed in. It's really a reflection of two things. We've obviously seen rising yields in the US as the economy is bouncing. The tapering of QE is being discussed and implemented as of December 2013, and of course a view on where interest rates are going to start heading if we start to see inflationary burdens. So that has obviously pushed US 10 years up, and now by lending to the government on a 10-year period, you're taking a close on 3% yield. In the US. In Spain, well, of course, back in the height of the European crisis, we saw yields there move up to around 7%, or just over 7% at one point. And it was really at this point in 2012 where we saw the spread between Spain and the US at its widest point. Since then, it really has corrected down very significantly, so that the premium that you now receive for Spain is just over less than 1%. 10-year yields now over Christmas really moving below 4% in Spain, back down to around 3.88%. So really been one of the major drivers of European stock markets has been this sort of closing in spreads this year. But of course we are getting to a point where questions will be asked whether it's an appropriate premium for lending to Spain, still with the economic conditions that it faces relative to the US at the moment. In terms of just to rattle through a few charts really to remind us of where we are, well, the FTSE very much towards the top end of its range, around 6,800, which it achieved in May of this year before the tapering talk. May of 2013 is starting the year just around those sort of highs. The euro, again, 138. It did sort of hit during the 2013 highs. It shied away recently back to 136, but key concern for the ECB this year is going to be the very low levels of inflation, the stimulus that it will need to continue to provide, particularly to those poorer performing regions within Europe at the moment, and that high level of the currency, which they really want to start inducing a more export-led recovery there. Japan was one of our top picks for 2013. It's started this year slightly in the negative. It was down 2%. Really the critical component there is how they can continue to influence what is happening with the yen. It weakened very sharply against the US dollar last year. They want more, and they will be sort of determined to do so. But some sort of strengthening in the yen has caused equities to start 2014 with a slight wobble, a 2% correction last year. I mentioned China. It had a disappointing year last year, and we'll be watching that index. It's one for the brave for us. Do take a look at that 2014 predictions video on more on the China story as to why we think that may just have a bit more of a resurgence. Just going to pull up the Marks and Spencer chart. It has opened weaker this morning at 435, so it's back on those sort of recent 6-month lows. Tried to recover out of this sort of 430 region once before, but it's back down there on the back of that Sunday Times story. So we'll be taking a look very closely at those numbers on Thursday. Tesco, likewise, there is a bounce there. Berkeley Homes, we're mentioning this one again. It is one of our stocks for 2014, certainly for yield income seekers. This is a good dividend payer. But the shares are also doing very well as well, and it was mentioned in a variety of magazines as a share for 2014 onwards, so has continued to keep their surge quite high. Finally, just to pick up on the US 10-year, as I say, really nudging on the 3% level, fairly critical sort of next step for the US 10-year and the influences that will have on markets. The UK has actually nudged through on the 3%. And of course we'll be going into a sort of quite a strong 15-month period of political noise that will be coming out, and it's going to be quite interesting to see the tussle between the cost of living and of course the cuts that George Osborne was talking about imposing to keep the economic sort of recovery on track, but also trying to produce a sort of reduction in the deficit and the debt position in the UK.